Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with Mike Agne. Futures Radio Show is sponsored by E-Mini Group. They're the world's leading and most diverse futures and options exchange. E-Mini Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. Today I spoke with CTA Manager at Magna Libra Capital Advisors, Mike Agne. I hopped on a call with Mike after the Fed announcement today to get his initial reaction to what the Fed said in their latest statement. And Mike gives us his thoughts on what the Fed has done thus far since the COVID-19 shutdowns began. Really, a majority of this podcast today is Mike and I having such a good conversation about the Fed and the massive impact they've had on U.S. equities. And last but not least, we sprinkled in a little conversation about gold and 10-year treasuries. So without further ado, let me take you right to the interview with Mike. Let's just jump into it. What are your initial thoughts on what happened with the Fed, what they did today?
Well, I think it was kind of obvious that, they're going to have to continue on with QE. And I was very glad to see in their dot plot that they're going to keep rates low or at least near zero through 2022, which is actually the first time I've seen them be honest with the market. Normally, those dot plots are very optimistic on rates moving higher as time moves forward. But this time they were wanted to convey the signal that rates are going to stay low and that they're going to be as accommodative as possible. And, so this is the first time I've actually seen them do it in all my years of trading, to be actually honest with the market. And whether it's through 2022 or even, I think it's going to be longer, but who knows what's going to even happen past then, considering our country's in uproar right now. So who knows? But I'm glad to see that. And it makes sense because, they have to, with the COVID that went through and now the riots and the uncertainty, they have to keep rates low. But, a lot of people will disagree with that. And, but it is what it is. So you can't fight it.
It's even more bullish than I thought that it would be. Just because of the things that you were talking about, their cautious tone on the economic outlook. They acknowledge financial conditions have improved. And when I saw the 2022, I thought similar to you that, they're like, it's just full speed ahead.
Right. And how much more can they do? I mean, they've obviously doubled their balance sheet in the last 10 months. And, we've never seen a shutdown in a global, not just the U.S. economy, but a global economy. So that was the right response. And, obviously people don't agree. You get a lot of naysayers saying, well, how can we have 30 million unemployment? The NASDAQ's making new highs. And I've always said the only thing that really matters is the monetary base and whether or not QE is on or if it's off. That's all that matters to asset prices. Throw the other stuff out the window. All the traditional macroeconomics, forget it. It doesn't matter. It's if they're printing money, assets will rise because the money will all flow there.
For my friends out there that are not traders and they don't understand this, they always ask me to explain that to them. They're like, well, I don't understand that, Anthony. I mean, look at everything around us that's happening. You say the reason we're going up is because of the Fed. But you and I, as traders and been following this stuff for many years, we understand it. But can you just explain to everybody why that is the case? I think even some traders out there will probably learn something from this.
Well, if you look at how our system works, our monetary system, the Federal Reserve is a private organization in charge of our monetary supply of dollars. They're not U.S. Treasury dollars; they're Federal Reserve notes, and the U.S. Treasury borrows money, and the Federal Reserve issues the money. So if they're expanding that monetary supply, people will look at that. You'll get a lot of inflation guys like, oh, that's inflationary. It's inflationary. Yeah, it is, but it's also debt. and the debt has to be paid with interest. And that's what's really, really the deflationary factor is, yeah, you can print money and money is inflationary, but with the debt rising, that's going to cause problems because you always got to pay that debt back. So there's going to be always that push and pull. But for, just to understand it in terms of asset pricing, if money is going up and money's rising, then you have a high-powered catalyst behind you chasing pricing, because obviously it's like a supply-demand thing. Even if the demand's low, if the supply of money is there, it's going to find, everyone's got their different risk tolerances, but it's generally going to go and try to make more money from the money, right? Let's just put it in the general terms. You need capital to make more capital. It's always been that way. And when you've got high-powered money like QE, you're buying every asset out there from, the Federal Reserve is printing money. And I was glad to see Jerome Powell actually admit it on 60 Minutes. Yeah, we just digitally create it. It's great. Yeah. So the honesty from the Fed lately is awesome. Like the transparency, they're just basically telling you, like, look, we are going to do this. And if you don't like it, we don't care. The people that want it need it, and asset prices are going to rise. Money's going to go towards, buying NASDAQ. And if you look at, they're only buying 5 of the stocks out of that whole thing. It's been obvious. But yeah, so from the simplest terms, it's if they're printing money, it's going into risk assets. And it doesn't matter if there's millions of unemployed because, yeah, I mean, it does matter on a civil society level, I do believe, and I'm not a big fan of that, of the destruction of civil society. But in terms of asset prices, the NASDAQ could care less of where the real general economy goes as long as money is being printed. Now, that could all change, Anthony. I mean, that could, we could really get some geopolitical events that happen, and that then risk is going to be completely taken off. But for right now, it's like they're printing money and it's going right into risk asset. I don't know if that was a good explanation.
No, it was. It's just... it just makes me so bullish, the S&P, because I just look at everything now and say, after everything that's happened, we know what the Fed has done. As somebody I've seen bull markets, I've seen bear markets, and when there's a bear market, there's always news that triggers it, breakdown of technicals, and then everybody comes in all at once. And this reversal now that we're back up here, and the reason why I'm so bullish S&P now is, and you say that after we've just rallied 1,000 points, is because I just look at the bears and go, they're now rubbing your face in the dirt. Like you said, it's like the Fed is more open about it. And you just look around and say the market has bounced every headline, every negative headline. Even today as we record, there was some negative news this morning I saw out of Texas with an increase in COVID cases. You saw the market hit a little bit, and then now I'm watching the S&P, it's right back to unchanged. It just feels like this is it right now. It's only about the Fed. We're in an interesting time in history, and I want you to talk a little bit more about the dot plot to 2022, because I actually put a tweet out and said the S&P may start to go back down in 2022, because it really, the more I look at it, I go, why go down now?
Yeah, right. Exactly. Like, what would be the catalyst, right? And if you look at, normally, and this being in the being a trader, it's like retail's always last to the party. And what has happened in the last 3 months is like you've seen a major increase in TD Ameritrade and Schwab and Robinhood accounts, and these guys are all coming in here and taking, they've had time off to sit at home or whatever, and obviously been sitting around and going onto the screens and piling into these things. So you do have retail coming in here and supporting this. And for me, I look at that as a contraindicator always, as like they're always late to the party. Now, if they're going to do this, I always think, and this is the conspiracy theorist in me, thinking that this market is controlled by 1 or 2 big players, and their algorithms will sniff out when it's too complacent. They've got enough people painted, and I call it like the roll tech maneuver, and that's not my saying, but that's been around for a long time. They're going to get everybody one way, all bulled up, and then we don't even know what the catalyst could be. It could be a technical level, it could be whatever, but they're going to reverse this thing out of nowhere and punish people. And I don't know when that's going to be or what it's going to take or what headline, but it's going to happen at some point. But it could be the little widowmaker trade too. You could be waiting forever for that. But for now, it's like we are definitely extended Some of the indicators I watch, and when you see volatility rising on an up market, then I really think we're kind of getting into that point where we're kind of getting a little bit overdone here. But over the long haul, the Fed is saying, look, we don't care. We're going to print money, and if you're not long this stuff, then you're a fool. That's basically what they're saying.
Yeah, I mean that's what I'm saying too. I agree. I mean it's like
and I'm agreeing with you. Yeah,
the trader in me is. I struggled the last couple of weeks. I've been very open about this. I mean, we open up at resistance every day. As a trader, I need rotations. This is not a great trading market for me, so it's not like I'm wishing for this rally. It may be good for the portfolio, but as a day trader, I'm looking at this going, this is tough because I don't care how technically based you can be, and you come in every day and see the markets opening up at or above your resistance every day. I'm not a breakout trader.
Every day.
How do I step in and trade?
No, and it's tough to do that. I don't know. How do you do that? You're always constantly buying highs. I mean, that's what it is. And, it makes it very difficult because you're right. There's not much two-way flow. It just seems like you're just, if you're playing it real tight, I guess there might be if you're playing 6-7 handles either way in that S&P. But, it's just, and the Nasdaq's a whole other animal. That thing is just, it's just up every day. There was a time there a little bit like a week or two ago where the S&P and the Russell were starting to get a little back. And, that, to me may be signaling a little bit of a top as well. But the Nasdaq the last few days has been just outpacing. So. It's just like, how do you do that? Is just everybody just going into the Fangums? Is that all you really need to do? Just buy Fangums and short the SPY? Is that really that easy? Maybe it is.
I mean, that's the one thing about this time that has been so interesting to me, and is really bad investing has worked. It's just taught a really bad lesson.
You mean like complacent?
Well, just like people come in like this Portnoy guy, right?
Yeah. Yeah.
Guys like him.
Is that the guy that said I'm better than Buffett, right? Is that him?
The Barstool Sports guy.
Yeah, I kind of like him. He cracks me up. I don't know how good he is, but
he's funny. But it's like I look at him, and in the past, I would see something like that and be like, I have to get short right now. You know what I mean?
Yes.
Like what I'm saying is like when people say things like that and I see that, I'm just thinking to myself, you touched that long button today. I'm going to put something there that doesn't allow me to be a buyer when I see him doing this. And it just keeps working. That's what I'm saying. It's like this. It's teaching like a lot of bad lessons.
I agree with you, and I can attest to. I have neighbors, now that we're all coming outside again, and we're sitting around old school 50 style in our lawn chairs on the front, and every single one of them is in the market trading. Every single one. They're not even trade. They're like lawyers and what. So you're right. To your point, we are getting to that point. I just don't know what the catalyst will be.
Yeah, and that's what makes it so difficult, right? Because it's like every bone in my body says we should be rotating. Everything I look at, I mean, it says that we should be rotating, and we just power ahead, and just getting back to the Fed. It's just, like I said, it's just one of those things where you even had like Druckenmiller who came out and said,
yeah.
You know what? I missed this rally. So it's not like it's the most participated in rally. A lot of the smartest people, I think, are the ones that probably missed it in a lot of ways, right? And, I want to talk a little bit more about some things. I want to pick your brain a little bit more about some things about the Fed, because you and I could talk all day about, what's going on here from the trading side. But there's been a lot of talk about repo, and it's just one of those things. I mean, it's not my strong point to understand a lot of those things, but I read your letter and things that you put out to understand more about it. Explain to everybody what repo is, because I think probably a lot of people still don't know what it is, and explain to everybody what has been going on with it and why it's such a big topic. Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com.
Obviously, it depends on what someone's real description of like what they really, repo. It's just a short-term overnight, sale and repurchase agreement. But I look at it in the simplest terms of a liquidity need. So the Fed can do a reverse repo there. Let's just look at it like from taking money away or adding money. If they're doing a reverse repo, they're pulling money back from dealers and participants, which is a tightening, right? And if there's repos are expanding, that means that there's a need for liquidity, and the Fed is giving out that liquidity in an overnight repo. Now it's got to be, obviously reversed the next day. And I argued with somebody about this, because reverse repos and the repo weren't adding up. And so I was like saying, well, shouldn't they add up? Like, shouldn't whatever's being repoed on a cumulative basis every day, shouldn't the reverse at some point in the future? Shouldn't a reverse? And they were like, no, they're two separate things. So I'm like, okay, so maybe I'm wrong on that, but without confusing like your viewership, I just look at it as like a liquidity add or a liquidity taken away. So if they're doing reverse repos and they're taking money away, and if they're adding repos, then they're adding liquidity because there's a need out there. Somebody needs a balance sheet need. They have a security that they need to get cash for, and they need the cash. So that's how I would, in its simplest form, look at it as adding liquidity or taking liquidity away. So if we look at what's gone on in the repo market the last week, we've seen a couple prints over 100 billion. Now we're already talking about after the Federal Reserve has expanded their balance sheet, 2x in the last 10 months. And now we're starting to see, as the Fed is saying, like QE is starting to come down a little bit. They're limiting it. But what you'll see is now you're starting to see that uptick in repo again. So to me, there's a liquidity need. And it makes sense because as you push asset prices higher, it's going to cost more money to keep that going, right? Everything's getting cumulatively more expensive. So in order to keep this game going, your leverage has to increase. And in order to get access to that leverage, you need cash and repo. So I've noticed over the last, week, we've seen prints up as high as 120 billion, where they were down to nothing at the beginning of May. Or at the end of April, they were down to like 2 billion. But as May started coming, you start to see get up to 30, 50 billion. And then June hits, and the first week of June is all above 50 billion basically. And now we're at 120 billion. On June 8th was the last one I saw, was 120 billion. So you're starting to see liquidity, needs again in the market. And to me, to add to your point again about the S&Ps or the equity market rotation, if they didn't supply this, I bet we would be lower. But you can game and lever the system if you have access to this stuff. And that's why if they're going to reverse out QE and say, oh, we're going to limit QE, then we're definitely going to see an uptick in repo, which is what we have been. And they can game the market even further. So it's very tough. As a trader, if they didn't have access to this, we would be lower. There's no doubt in my mind if repo wasn't 100 or 50 billion a night, that we would be lower. But because they have access to this, they can game it and continue this. And that's why I said, I really think the market's controlled by one or two large players. And you can speculate who those guys are, but without this liquidity provision, the markets would be lower. But the Fed, like I said, is all in and willing to do whatever it takes to provide all this liquidity. I mean, even if you look at outside of repo, you look at all their facilities they've created, all the alphabet soups of MMLF or CB, whatever they all are, CBPP, the commercial backed facilities, now the municipal liquidity facilities, which Illinois, I think, was the first one to tap, obviously. But with all this liquidity, we can keep using leverage to drive markets higher. The only problem and the caveat of it is it gets more incrementally expensive to do that. And so that's the real dilemma the Fed's going to find itself in, is we're going to keep creating all this debt, and you're going to have to keep providing all these liquidity provisions. And, these numbers, like the law of large numbers is starting to show up here. It's like you're going to take so much of the market and basically rig it that the rest of the economy, and this is how you can explain it when you were saying, like, explain it to normal people why monetary mechanics matter, is because it doesn't matter what the rest of the economy does. If you're printing money and you're adding all this liquidity, then you're going to get asset price rises. And, and that's exactly what we're seeing. And so I'm not shocked to see repo up above 50 to 100 billion. It's going to be, even higher in the, if they want the market to go higher, this is going to be higher. So, doesn't make sense to the average person because they don't see the effect, but that's what we're seeing in the overall market.
I'm so glad I asked you that, because that's the best explanation I've heard. And I've been, when you read a lot of stuff, like I do, sometimes I get these things, I understand them, and then, all of a sudden, kind of a light bulb goes off, and the way you just explained it really just helped me understand it more and more. So thank you for that. And a couple things I want to talk about is I was actually listening to CNBC today before the Fed meeting, and I was hearing, I think it was a former Fed governor. I'm not exactly sure. I believe his name was Bill Lee, but I'm not 100% sure. I'll actually go on Twitter for everybody listening to this and post it. He was on the exchange with Kelly Evans at the time. Anyway, so I don't know if you heard that, but what are your thoughts on that being a possibility that the Fed at some point does that?
I don't think that will ever happen because they have the dealers to do that. So look at what they're doing. Obviously, they're giving the money to the dealers or whoever, the 30 participants that can participate in, be the first to the spigots. So when somebody says that, like a Fed governor or whoever that was that said that, he knows the truth. They are buying equities. They're just not doing it directly. They're doing it indirectly. What's the difference, Anthony, if I gave you money and you bought the equities, or I just bought them myself?
Yeah, I mean, so just
right.
So what
it's
Michael,
just a conduit. It's just a semantics kind of thing. Yeah.
So what Michael Leibowitz said to me in my latest podcast, he was talking about how the Fed, he says, I'm not saying that they're buying stocks, but they are buying junk bonds, which have a high correlation, yes, with stocks, which in turn is something that is driving the market higher. What do you think about that? Okay.
Yeah, he's 100% correct on that. And that is a problem too. Think about all the misallocation of resources that this is causing. You're not causing businesses to be fundamentally sound, be fiscally responsible. You're saying, look, take all the risk. We don't care. Spend the money. And if everything goes awry, we're just going to buy those junk bonds. Don't worry about par value, because don't worry about those things collapsing. We're going to come in and give you that value. Just think about how asinine is that you're removing all sense of moral obligation by these corporate treasurers and these even companies that these VCs back, because it's like nobody. If the Fed's always going to be there to backstop, then where's the limit? How far do you go? How irresponsible can we get? And that's the real shame of all this. And it's as more of an Austrian economic study where you want organic growth to come from savings. It's coming from debt, and that's problematic because debt comes with interest, and these numbers are going to start outpacing the reality. And that's why, to me, and not to change the subject real quick, but Leibowitz is right. He's right. They are monetizing directly in that regard. But will they move from junk bonds to outright ETFs and equities? I don't think they'll ever go that far, because I think you'll really get a major backlash, and that becomes very obvious. And I don't know if it's counterproductive, because if you look at the BOJ and the Nikkei, they've been doing that for decades, and we haven't seen that price appreciation over there. They've just been accumulating. But as I say, and as I write about all the time, these are non-zero sum players. So their weighted average cost of capital is negative. Basically, they're printing. They can't. So people say, well, they can take a loss. No, they really can't, because they're not. Their cost of funds is zero. So they're not going to take any loss ever. So that's wrong. But he's right. They are monetizing directly in the junk bond market, which in de facto could spill over to when you monetize those junk bonds, they can take that capital and buy. It's going to be obviously good for the equity, whatever the underlying security is. It's going to be good for the equity as well. But I think the riots that we're seeing, it might. And I don't want to get political, but I'm not going to, because I really think it's economics. I think people are rioting not because of they have this idealism of what they want to push. I think the income disparity is the real underlying problem, and it's not being addressed, especially in the poorer neighborhoods. I think that's the real problem. And I think this kind of action from the Fed is a direct result of a direct cause of that disparity. And that's something that needs to be addressed, or else we're going to see a breakdown in civil society. When you talk about, things turning over, that the market will collapse if that happens.
Yeah, and speaking of Mike Leibowitz, I actually was just watching Twitter right now as we're talking. I was just trying to see all the headlines come in and what everyone's talking about. And he said more debt equals long-term economic damage. Fed too blind to understand that unproductive debt is bad for futures growth.
Yeah, well, I would agree with that 100%. They won't ever say that, but yeah, that's the difference between debt growth and savings growth. It's as everything gets more expensive, as the monetary base increases and asset prices increase, then prices go up, and it takes more dollars to buy that same level of good or service. More debt has to be issued, which comes with more interest, which comes with that's highly deflationary. As much as the inflationistas doesn't want gold to rise and all that, all this debt is super deflationary. And so it's like filling this hole. I always equate it to like standing in a bucket and trying to lift yourself. That's what they're doing. And all it's doing is you're dislocating reality, the common person that has that's living the basic average life of basic average wage or whatever that is. Maybe it might be a little more. You're dislocating those from the very few asset holders. Let's call them the top 20%. Because let's be honest, where does QE go? It goes into the markets, and who owns the markets? The top 20% own it. So you're going to get, and even if you look at the top 1%'s income or total share of the assets has risen 44% in 30 years. While the lower 99% can't even, and I say 99%, which is crazy to say, can't even keep up with that. So you've got 1% basically taking all the income, at least 40% over the last 30 years. And that's a problem to democracy. It's a problem that I see in the large conglomerates, the Facebook, Amazon, Google, Microsoft. These guys control and wield far too much power. And I got backlash on Twitter when I called it antitrust. Something needs to be done because the influence and reach that these few corporations have on individuals and the influence they have is also a threat. You could push narrative very easily, and I don't agree with that. But that's all a systemic effect of these QE policies, where you're concentrating wealth in a very few hands, and it's almost like created like a what is it? Almost like serfdom. And somebody else uses that word, or was it Ben Hunt maybe? But that's what you're seeing. We just don't have the kings and queens walking around, but they're there. The massive wealthy are there, and then there's everybody else, and so you create this two-tiered economy. So I agree with that the more debt is detrimental to long-term growth. It's just that when is that time period? I always say the Fed's very good at buying decades at a time. Chairman after how many chairmen have we seen? Chairwomen have we seen, Anthony? It's like they just buy decades at a time and hope that status quo, hope that division amongst the common people stays, and they can just keep inflating. Because that's the reality. It's like their mandate seems to just keep targeting asset prices, keep the 1% very happy, and the rest of the economy will just, will go through the decades like they matter.
Yeah, I mean, we're running a little short on time here. What I wanted to do is I wanted to just talk about two markets that I also watched the reactions today. I mean, we talked a lot about equities, and we talked about how we feel about them, but obviously, on Fed days, I'm keeping an eye on two other markets for me.
Yep.
Three, actually. I look at the dollar, but really I want to talk about gold and the 10-year. First, I want to get your thoughts on gold, and then we'll end with the 10-year. So what do you think about gold's reaction today? It's up $16 as we speak. And what do you think for gold going forward? Yeah. Hey, everybody. I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com.
Yeah, I think it's definitely bullish. It's obviously, with all this printing, you're going to get a lot of fundamental buying, a lot of, even central bank, I think, buying in it. And, there's always this battle between gold and silver, right? And like silver's gotten beat up, most of the, except lately it's starting to outpace it again. And it's so between gold and silver, I don't know which one I'd rather own, but I think owning the metals in this environment, I don't think will hurt you. I don't think will we get a pullback. I hear a lot of people are waiting for this pullback. I don't know if we'll ever really get one, considering the Fed's on hold now indefinitely. I think the pullbacks will be very slim. I think the market is very bullish. The fact that we're not above 2,000 is, I don't know if that's part of that paper selling that can go on, and they can, lever sell against that thing, and on the derivative side as opposed to. But if you look at the physical market, the premiums are huge. Spot silver in the physical market versus what you could actually buy as a physical is completely out of the realm of the basis is wide, and it shouldn't be that way. I was always like, somebody asked me why don't you just buy silver or gold and take delivery? Why would you pay in the spot market and take on physical and pay that big of a premium when you could just use futures and take delivery? But not many people have that capacity to do that, but but no, for me, I'm bullish metals, and the premiums in those markets tell me to be bullish. The Federal Reserve tells me that you should be bullish. The global economies tell me you should be bullish those metals. And eventually, with all this debt, Anthony, the central banks are going to have to start realizing that they're going to need to start backing this stuff a little bit more. And I think that's going to be in the plans in the future. I think we're going to start to see the U.S. Treasury start to come in here and accumulate more gold. So I'm very bullish on it. I think that the dips in those markets will be very, very shallow in terms of gold and silver, and obviously copper's a little bit more. Copper's bounced quite a bit actually, and I don't know if that's part of the Australian dollar being strong or part of maybe a turnaround in Asia after this COVID stuff. So, but the complex in general, I'm kind of bullish on it. I don't know if you had that one major dip in silver. I think it got down to like $11 or something. I don't think we're going to see that. I shouldn't say that, but I think the dips will be shallow. I'll just leave it at that. I think the dips will be shallow, and I think I'm very bullish on that complex.
Last market is the 10-year. You and I have talked a lot about the 10-year over the years, and for me, really, it was probably my primary market besides this
10s.
year. The last 2 years, I traded the 10-year ultras a lot, and this year S&P really took hold as my primary market, and again, I came back to it, and because obviously with all the volatility, and then I started to look at 10s maybe about a month and a half ago. I said, you know what, let me see if maybe I start getting back into trading these a little bit more again.
Yeah.
And really, it's like a light switch has gone off in that market. I mean, it has just gotten so quiet and tight.
It's real tight.
And it literally was like a light switch went off, and a lot of talk about this yield curve control.
Oh God, I hate that.
Right?
The YCC.
So, the YCC. This is
sounds so academic.
I know it's another new thing that we got to go and read about. But I'm just curious as to why do you think that the 10-year has really just, like I said, it just feels like the lights have been turned off. I mean, besides that one little blip lower that we had, and it's rallied right back now into that same range. Just your thoughts on 10s. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com.
Well, I think you got to look at 10s in two different aspects. You got to look at it as the long end of the short end and almost like the short end of the long end. So you've got those two poles of we know the short end's anchored, right? We know that the Fed's not going anywhere. So you're going to basically be long that and short the 10-year, whether it's be Eurodollars, 2s, 3s, 5s, 7s against the 10 in terms of the steepener. So, but if you look at the opposite side, the 10-year is going to be bullish against, the ultra versus the ultra bond versus the bond. And so you got to figure out at what point is the long end going to, start to discount this future even further. So when they say yield curve control and YCC, it's this new thing. No, we had Operation Twist in 2011, 2012. That's YCC. When the Fed is outright saying we're going to buy long end and sell short end, well, that's YCC. Okay, but it's called Twist back then. So no, we've already had that. And this is nothing new. They've been doing this all the time. But the 10 years kind of landlocked, to be honest. I kind of pegged the range a little bit from like 111 to kind of like 65 basis points in that range, 1.11 to 0.65. But we've actually been really tighter than that. We've had a little bit of a breakout here above 90, but that obviously has been, taken back relatively quickly. I think that's too far, but because we're not going anywhere, right? That's what the Fed is telling us. We're not going anywhere. So for me, much like the gold market, I think the 10-year is anchored and buoyed, and the fallbacks in there will be very short and shallow, because the real risk is long-term zero. And you're going to pick up, I don't know, what's the 10-year now, 75 basis points, and that's going to drift lower as time continues to move right here, and the Fed realizes that everyone's going to figure out we're never going to leave zero, and we might even actually go negative. Yeah. And so we get to that point, forget it. I mean, this thing could rally huge in terms of price and fall big in terms of yield. So I like the 10-year on dips. I think the dips will be very shallow, much like gold. And, it's landlocked, though. Like I said, it's the long end of the short end and the short end of the long end. So you've got those two forces pulling on it. And I think it's going to be stable, like it has been kind of locked like that, because you've got those two forces. Now, if you want a little bit more play, you can move out. If you're going yield curve, I like to watch that FOB, and that that's been on fire. 5 years been outpacing, but that too is kind of hit a little bit of a resistance. So, for your listeners out there, if they're looking for a little bit more movement, you got to kind of the 10-year might not be where it's at. You might have to go a little bit wider in terms of duration, which is like going from a twos, maybe a 2s10s or a 5s30, something like that for play if you're looking to play that angle.
Yeah, and I see that in the chart as well. That's just what it looks like to me. And sometimes those narrow, tight ranges, if you really have conviction with fundamentals and the Fed behind you, you can use that as an edge. I was just curious what you thought as to why the volatility got sucked out of it so fast. It was just like a race to get to this range, and then it just stopped. But
it just stopped.
Yeah, it just stopped.
So today will be interesting though, Anthony. It'll be interesting to see how we actually close here. If the 2:00 close is already going to be in, but how the rest of the day goes.
Because they took out the low, and then maybe they go back. And I'm talking futures wise, they took out the low that they've been in, and maybe now they shoot for that high.
Yeah, no, exactly right. So that rotation that who knows? Today might be the day, but I don't know.
I could have jinxed them. Yeah, but
you could have. Yeah, that's right.
It just looks like it's by the dip across the board. Not my favorite markets, but hey, you know what? It is what it is, right? I mean, we've got to adapt to what the market is. And this is what it is. So, Mike, great stuff. I noticed you recently launched a newsletter that you're putting out. You've been putting out a ton of great content lately. And just talk to everybody about that and where they could find you on Twitter.
Oh, so at Twitter, it's at Michael Agne 1. And then the newsletter is econemotions.substack.com. And I don't know, Anthony, if you could link like in the show notes or whatever.
Yeah, I will.
So this newsletter I'm putting out because, I feel like that education is key, and breaking down these subjects so that the general trader that might not have in-depth knowledge of economics or monetary policy. So I try to break everything down that on a daily level that could help traders like analyze these markets and make better judgments and decisions. And so that's a lot of that free content that I put out daily. And then I have a subscription side that'll get more of daily settlements of the markets that I cover or that we cover, and ranging from fixed income currencies, metals, energies, and equity indexes, and even the cash markets that we like to follow, which is the 30s, 10s, and 5s. And even some of the German fixed income and the DAX market. So all that's included in there. And then now, so Magna Libra's Capital Advisors runs a global benchmark futures program. And so I'm putting up, we have this, I've created like a proxy market indicator of positioning. So I'm even putting that for the subscriber base up on the newsletter to follow. To track kind of our sentiment of what we want to be long and short in the markets that we cover. And it's kind of like how I hate to use Gartman because I think Gartman is terrible, but but he's got a huge following. So I shouldn't say that, but I just think he was always a floor contraindicator, right, Anthony? If Gartman's putting something out.
For a while he was.
Yeah, for a while. But I just think that exposure for new traders might make sense of saying like, oh, why are they tracking that way? And we've got, a bunch of proprietary indicators that give us those outputs. So I'm putting that out there because I want the exposure, and hopefully people gravitate towards learning and realize that like you got to look at these things in multifaceted ways. You can't many people are just S&P traders, or many people are just gold traders or oil traders, but in reality, all these things affect one another. And I think that's my goal, is trying to mesh all that together for traders and say like, even if you are just kind of more stuck with one market, that if you take a look at these other markets, they might start making sense to you if someone's giving you exposure to them. And that's my real goal with all that.
Well, that's why I read so much. And I, for me, in my own world of trading, I'm very focused on my strategy and my self-awareness and things like that. But because definitely. We're in this industry, and it also impacts us beyond just trading, like understanding these things. For me, it's not necessarily that all of this stuff will help me with my trading because of the way that I trade. And I think that a lot of people out there can relate to that, but it's an understanding of what's going on. And
exactly.
For me, it just really helps me just understand the environment that we're in, and just not put a blind eye up to it. Like, I mean, when you started to see these rallies taking fold, I said to myself, you need to start doing more reading as to what the Fed has done, because you just underestimated how much of an impact this is really having. And when you see it going up with gold, going up with 10-year, and all these other things that we talked about today, then you have an understanding of what's happening. And it may not help you maybe as a short-term day trader, but then again, it may on days where you see things that are happening and you're like, you know what? I've always said technicals will help you get into trades. Fundamentals will keep you in trades. So
that's right.
Exactly. And your stuff is great, right, Mike. So everybody check it out and follow Mike on Twitter. Mike, thank you again so much for taking the time to speak with me today on Futures Radio.
All right, Anthony. Awesome. Thank you. I really appreciate it.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.